Welcome back to the channel. Today we're diving into a crucial topic for all traders out there: how to spot whale trading behavior. Knowing when a large trader or institution is making moves can give you a significant edge in the market, allowing you to anticipate big swings and potentially capitalize on them. Over the next few minutes, I'm going to break down 11 key indicators that can help you identify these whales, from analyzing unusual volume spikes to understanding options activity. So, buckle up because this is information that can seriously up your trading game. Let's get started. The first thing we're going to look at is unusual volume spikes. Think of it like this: when a whale jumps out of the water, it makes a splash, right? Well, when a whale makes a move in the market, it creates a similar kind of splash in the form of a sudden and significant increase in trading volume. You're looking for volume that is way outside the norm for that particular asset. Now, to really see this clearly, you're going to need to use volume indicators. Most charting platforms have them built in. Compare the current volume to the average daily volume, and if you see a big difference, that's your first clue that a whale might be swimming nearby. Next, let's talk about order book analysis, which is like getting a sneak peek behind the curtain of the market. The order book shows you all the buy and sell orders that are currently open for a particular asset. What you're looking for here are large buy or sell orders, often called walls. These walls can indicate strong buying or selling pressure, and they can be a sign that a whale is trying to accumulate or unload a large position. But be careful, whales are sneaky. They sometimes engage in something called spoofing. This is where they place large orders and then cancel them before they're filled, just to create false signals and manipulate the market. So, while order book analysis can be helpful, it's important to use it in conjunction with other indicators. This one might seem obvious, but it's crucial: unusual price movements. When you see the price of an asset suddenly skyrocket or plummet without any clear explanation, there's a good chance a whale is behind it. They have the capital to move the market, and they often do so aggressively. Now, to spot these unusual price swings, candlestick charts are your best friend. Look for long green candles, that's buying pressure, or long red candles, selling pressure, that are much larger than the candles around them. Also, keep an eye out for gaps between price levels, which can happen when a whale places a massive order that gets filled all at once. Chapter 4. Whale Wallet Tracking. Following the money, crypto only. This next indicator is specifically for the crypto market's whale wallet tracking. The beauty of blockchain technology is that it's transparent. We can actually see large transactions happening in real time. So, if you're trading crypto, you can use blockchain explorers like Etherscan or Whale Alert to track large transfers to or from exchange wallets. These are often the wallets used by whales to buy or sell their crypto. And pro tip, follow some whale tracker bots on social media. They do a lot of the work for you, sending alerts whenever a big fish makes a move. Chapter 5. Open Interest. Gauging the Sentiment. Now, let's get a little more sophisticated and talk about open interest, especially in the futures and derivatives markets. Open interest tells you the total number of outstanding futures or options contracts that haven't been settled. It's a measure of how much interest there is in a particular asset. What you want to look for here are sudden changes in open interest. A large increase in open interest, especially when it's accompanied by a rising price, can suggest that whales are entering new positions. Conversely, a large decrease in open interest, especially with a falling price, could signal that whales are closing out their positions. Chapter 6. Price Consolidation and Breakouts, the calm before the storm. This next indicator is all about reading the charts and understanding patterns. Whales often accumulate their positions gradually, which can lead to periods of price consolidation. This is where the price of an asset trades within a tight range for an extended period of time. It's like the calm before the storm. On a chart, these consolidation zones look like rectangles or triangles. The breakout happens when the price finally breaks out of this range with high volume, indicating that a whale has likely decided to make their move. Chapter 7. Spread Manipulation. Don't fall for the trap. So, let's talk about spread manipulation, another sneaky tactic that whales sometimes use. The bid-ask spread is the difference between the highest price a buyer is willing to pay, known as the bid, and the lowest price a seller is willing to accept, known as the ask. Whales can manipulate this spread by placing large orders slightly above or below the current market price. This can create the illusion of buying or selling pressure, tricking other traders into buying or selling at unfavorable prices. So be wary of unusually wide spreads or sudden changes in the spread, as it could be a sign of whale games. Chapter 8. News and Social Media. Sentiment is everything. Never underestimate the power of news and social media sentiment, especially when it comes to spotting whale activity. Whales often try to influence market sentiment to their advantage. They might spread rumors, release positive or negative news about a particular asset, or use social media to hype up or bash a stock or crypto. Your job is to stay informed and cut through the noise. Use tools like Google Trends or Lunar Crush to measure sudden shifts in attention or sentiment around a particular asset. If you see a sudden surge in search volume or social media mentions, it could be a sign that a whale is trying to orchestrate a move. Chapter 9. Stop-loss hunting. Don't be the prey. This next one is a bit devious. Stop-loss hunting. Many traders use stop-loss orders to automatically sell their assets if the price falls below a certain level, limiting their potential losses. Whales know this, and they sometimes try to trigger these stop-loss orders to buy assets at a lower price. How do they do it? By pushing the price down to a key support level, triggering a cascade of stop-loss orders. This creates a sudden drop in price, which the whales can then exploit to buy up those assets on the cheap. On a chart, this looks like a price movement that wicks into a key support level before quickly reversing. Chapter 10. Unusual Options. Activity decoding the derivatives, stocks and derivatives. This one's for the options traders out there. Options are contracts that gives the right but not the obligation to buy or sell an asset at a specific price, the strike price, by a specific date, the expiration date. Whales often use options to make large leveraged bets, and their activity can be a telltale sign of their intentions. What you're looking for is unusual volume in specific strike prices and expirations. For example, a sudden surge in call options, bets that the price will go up, with a strike price far above the current market price, could indicate that a whale is betting on a big move to the upside. Chapter 11. Market Depth and Liquidity. Navigating the Waters. Finally, let's talk about market depth and liquidity. Market depth refers to the number of buy and sell orders available at different price levels. Liquidity, on the other hand, is a measure of how easily an asset can be bought or sold without affecting its price. Whales have a much bigger impact on markets with low liquidity because their large orders can significantly move the price. So, it's essential to be aware of periods of thin liquidity where large orders can have a disproportionate impact. You can usually find market depth and liquidity metrics on your trading platform. Look for times when the order book is thin, meaning there are relatively few buy and sell orders available. This is when whales can really make waves. And there you have it, 11 key indicators to help you spot whale trading behavior. Remember, while whale activity can create volatility, it also presents opportunities. By learning to read the signs, you can gain valuable insights into market direction and potentially profit from their moves. Stay observant, manage your risks, and happy trading. Don't forget to like, subscribe, and hit the bell icon for more trading tips and insights.